All right, so we are going to do 14.3 work together. We have 3 steps in this work together. First step, it says for each of the notes signed by PLD Incorporated, complete the following tables. Use the first table to show your calculations of A, the maturity date of the note, B, the interest on the note, and then C, the maturity value of the note. You're going to use the second table to show A, the total interest, B, the maturity date, and C, the total maturity value. Okay, so I think we're going to do this by A, B, and C. Okay, so here are our 2 notes. They give us the date, the principal, the interest, and then the time. Okay, so we're going to look at first this NR3, and we're going to figure out the maturity date. Again, I don't know if you can hear Beckett in the background, but he really wants to talk too. Okay, so when we're looking at this, they've already filled in the days remaining. Now, they've created this great table for us, but I will give you a heads up. You will not get a table like this on the test. So it's important that you know how to figure out the maturity date. The table kind of helps walk you through it for now. You can always write out the table on your own while you're doing the test, but you will not get that for the test. Okay, so we have a 90-day note. First thing that we need to do is figure out how many days in June. Okay, so hopefully you know how many days in your months right now. June has 30 days. It was signed on the 5th, so we're going to take 30 minus 5. That tells us that we're going to use 25 days from June. Okay, so we're going to now take 90 minus 25 to get our days remaining. We still have 65 days. Okay, so next we're going to figure out how many days of July we're going to use. Now, there's 31 days in July, so we're going to use all 31 days. Okay, again, we're going to take 65 minus 31. We now have 34 days left. Now we need to look at August and how many days are in August. There are 31 days in August. So since we have 34 days left, we are going to use all 31 days of August. That leaves us with 3 days left. So the 3 days left means that we're going to use 3 days from September. Okay, so days remaining is 0. Okay, now I'm just going to go down to the next one and I'm going to do the same thing for the next one. Okay, so we're sticking with that same thing. So our next one was signed on June 12th and it's a 120-day note. So we have 120 signed June 12th. So we're going to do the same thing we did before. There's 30 days in June. So 30 minus 12 means that we're going to use 18 days from June. Okay, we're then going to take 120 minus 18. And we have 102 days left. Okay, there are 31 days in July, so we're going to use all 31. We have 71 days left. There are 31 days in August. We're going to use all 31. We now have 40 days left. There are 30 days in September, so we're going to use all 30. There are 10 days left, so that means that we're going to use 10 days from October, and there will be 0 days left. Okay, so our maturity dates then are September 3rd and October 10th. Okay, so next thing that we're going to do is we're going to figure out our interest. So to figure out our interest, we're going to take our principal. So I'm going to just fill in my principal amount. And then I'm going to look at my interest rate of 8%. And then this is that fraction. So it's 90 days over 360. So I'm going to type it into my calculator just like that. So 20,000. Oh, you know what? I'm going to go down here. Sorry. I'm going to fill this in as we already put in September, or we already figured out September 3rd. So I'm going to go here and say September, how did I go? September 3rd. And then for the next one, We said October 10th. So I'm going to fill that in. Okay, so now I'm going to do my interest. Sorry. So 20,000 times 8% times that fraction of 90 over 360. I get my interest then to be 400. Okay, I'm going to do the same thing for this next one, the NR4. So my principal is 10,000. My interest is 6%. And this one is 120. So again, I'm going to type that into my calculator, 10,000 times 6% times that fraction of 120 over 360. For this one, I get interest of $200. Okay, so the next thing I'm doing is figuring out maturity value. So I'm going to put my principal amount here, 20,000, times that interest rate that the interest that we figured out of 400. When I add those two together, my maturity value then will be 20,400. I'm going to do the next one. Principal is 10,000. I figured out my interest to be 200. When I add those two amounts together, my maturity value then is 10,200. Okay, so my top table is filled in. My bottom table is filled in. I'm going to grade step 1. Next step. Now I'm going to journalize transactions. It says journalize the following transactions completed during July of the current year. Use page 7 of the general journal and page 8 of the cash receipts journal. Source documents are abbreviated as follows. So we have 3 transactions. The first one, we accepted a 90-day 8% note from Gary Kinney for an extension of time on his account, $1,800, note receivable 5. Now, here's the thing. If you have trouble with the difference between notes payable and notes receivable, just pay attention to that source document. So this is telling us it's a note receivable. Okay. So what we're doing here is we are going to be transferring that accounts receivable into a notes receivable. So I'm going to go to my general journal for this one. And my date is July 5th. Now I'm transferring accounts receivable into notes receivable. So I'm going to debit notes receivable. The document number is NR5. I'm debiting for this 1,800. And then I'm going to credit because I'm getting rid of that accounts receivable. So I'm going to credit accounts receivable slash Gary Kinney for 1,800. Next transaction, July 12th, it says that we received cash from Mary James for the maturity value of note receivable 1, a 60-day 9% note for $500, receipt number 113. Now, we're receiving cash, so this one we're going to go to our cash receipts journal. So I'm going to go down, I'm going to put in my date, July 12th. In this one, they don't tell us the actual amount, so we're going to have to figure out those amounts. So we need to take the principal amount, $500, that was the principal amount of the note, times the percentage, 9%, times the fraction of the year. So it's a 60-day note, so 60 over 360. What I get for interest then is 7.5. Okay, so I would add that to my principal amount, and $507.50 is what I'm going to get for cash. Okay, so I'm going to put that in first. I like to put my cash debit in first, so $507.50. And then I'm going to put where I got that money from. Okay, so remember, they owed us money in notes receivable. So I'm going to do notes receivable. I'm going to put my document number into receipt 113. And I'm going to credit notes receivable for the principal amount. So the principal amount of the note was 500. My debits and credits don't equal because I also have to include that interest income. Remember, that is revenue that I'm making. So I'm going to call that interest income, and I'm going to credit for $7.50. Now my debit equals my 2 credits. Okay, last transaction is July 26th. Dennis Kraft dishonored notes receivable 2, a 90-day 9% note for $400, memorandum 25. So this is where he did not pay us on his notes receivable. So what we're going to do is we're going to transfer that amount from notes receivable into an accounts receivable. And we're going to take into account the interest that he owes us as well. So I'm going to my general journal. And July 26th is my date. And it's kind of going to be the opposite of this one. So I'm going to debit if I could spell, accounts receivable / Dennis Kraft, and memorandum 25 is my source document. And I'm going to actually leave the debit amount blank for right now, okay? I'm going to then go and I'm going to credit notes receivable. I cannot type today. Receivable for the principal amount, which was $400. Okay, so I'm getting rid of that notes receivable. I'm transferring it back to accounts receivable. But remember, I also have to look at the interest income. Now, I earned this interest income even though I have not received it. So I'm going to put in that credit of interest income. I do need to figure that out. So I'm going to take my principal amount times the percentage of 9% times that fraction. So 90 over 360. I get for interest $9. Okay, so that total amount is going to be my debit, 409. That is now what we're going to put into accounts receivable, specifically Dennis Kraft. He now owes us that for the dishonored note. Okay, I'm going to grade step 2. And next step. Now, I think that since my videos can only be 15 minutes, I'm just going to go ahead and stop at this one, and then I will create a part 2 for step number 3. So you can go ahead and go on and watch the part 2 video for step 3.